You're listening to another episode of the Young Investors Podcast, so sit back and relax as myself, Brandon, and my buddy Hamish discuss the latest in the world of finance and stock market investing. Now, a quick reminder before we get into the podcast is that nothing in this podcast should be taken on as personal financial advice. If you're ever unsure about your finances or investing and you need some help, make sure you reach out to a qualified financial advisor. But with all that said, let's get into another episode of the Young Investors Podcast. Welcome back, everyone, and first things first, happy birthday, Hamish.
Oh, thank you. I appreciate it. Welcome back, Brandon. How are you today?
I'm going well. How old are you?
I am 20. What do you think? Have a guess.
22.
Accurate. Spot on.
I remember, I think you said last time we were together that you were 21. So
Yeah.
there you go.
One year older.
You're younger than me. I'm 25. Oh, God.
Wow, 25. Yeah, you're...
I'm going to be 30 before I know it.
Yeah, it's a race from 25 to 30. It's quick.
Yeah.
It's going to be quick.
Man, 26 is nasty. You're on the wrong side of 25.
Yeah.
Anyway. I hope you have a good birthday. You got any plans? You doing anything cool?
Nothing. Honestly, nothing sort of big planned or anything like that. I've just been working so hard. Yesterday, someone asked me what I was doing today, and I was just like, "What are you talking about?" And I totally forgot that it was my birthday. Right. So it's been kind of one of those weeks. But
I'm working.
Yeah, I caught up with some friends last night and do some family thing over the weekend. But
yeah, cool.
Pretty quiet. Yeah,
good stuff. Yeah, birthdays, they seem to get less eventful the older you get.
Yeah.
I feel like there's this patch where, like, at the start of your life, birthdays are just amazing, and then in the middle of your life, birthdays are just completely boring and indifferent, and then towards the end of your life, then birthdays get exciting again.
Yeah, that's true.
It's like once you start hitting 60, 70, 80, if you hit like 90, every birthday, you're just cheering.
Everyone cares again all of a sudden.
Yeah, exactly right.
Yeah, but more importantly this week, it is episode 80 of the podcast. I think that's a nice sort of round number to be reaching. We're getting what have we got left? 20 weeks if we can.
20 weeks.
If we can maintain.
We're gonna have to we keep referring to this 100th episode number. We're gonna have to do something like off the charts.
Yeah, we've been building it up for
100th episode. Yeah. Gosh, don't just wait, guys. The 100th episode. Whoa, you're in for a treat.
It's gonna be a big one.
We actually have no plans whatsoever.
So we've got 20 weeks to plan. So
yeah,
we'll be right.
Well, one thing that caught my attention this week was that the NASDAQ, did you see the NASDAQ?
Yeah, record high.
Record high. I mean, Trump was certainly very happy to tweet about it. Did you hear that?
No, I didn't see that tweet specifically. I saw some other ones. Which one what was he saying?
Oh, no, he just said, literally just said, NASDAQ record high, or, that's so cool. And then I love Joe Biden's response. So he was just like, also 13.3% unemployed currently, millions of Americans unemployed currently.
Yeah, it is a bit like that. The tweet that I saw from Trump, which earlier this week, was he was talking about the airlines, and he was saying that Buffett made a mistake selling them because they were up so much this week. I think on one day they were up like 10%. And
God damn.
It was just so funny because that kind of comment is pretty much like half the comments we see on our YouTube videos, where it's like you talk about a business and you say, well, this business has quite a bit of debt, so maybe be careful. And then all the comments are like, but it went up 6% this week. So you're wrong. Yeah. You're wrong.
Trump, I'm shaking my head. Gosh, how can you make such a rookie investing mistake? Anyway.
Everyone's been on Buffett's back this week. Do you see that day trader that was claiming that he's better than Buffett?
Oh, no, and I'm glad I didn't, because all right, mate. Yeah, all right, mate. That's what you say to those kind of people. Yeah, all right. It's like I got a comment once being like, I can't even remember. It's just like, man, I'm never following Warren Buffett again. There are so many better investors in the world right now. And I was like, you want to name any of those? I didn't get a response because he can't. He's still the world's best investor by a long way.
Yeah, well, he does have the most money out of people who are investing in a number of different businesses. So,
yeah. Anyway, let's get through our sponsor, then we'll get into some of these news stories.
Yes, absolutely. Yeah. So today's episode is sponsored by Sharesight. So Sharesight, as everyone knows, is an application that I've personally been using for the past few years in order to track the performance of my stock portfolio. And the reason why I use it is because it allows you to keep track of your capital gains, dividends. If you have dividend reinvestment plans, it will do all of those calculations for you. Currency gains, if you're buying shares internationally and or you hold foreign currencies. And then, of course, the main reason why I use it is for tax time. So Sharesight will allow you to generate up to 10 different reports that can be used at tax time to basically easily work out your capital gains, your dividend income, and more. And you can try Sharesight for free by heading over to sharesight.com/young investors. That's site spelled SIGHT. So sharesight.com/young investors. And you can also use that link to get 4 months free when you sign up for a yearly subscription. So if you want to check it out for free, you can. There's a free plan. But also if you want to use a paid plan, get yourself 33% off by using that link.
Sweet.
Cool. All right. Where should we start?
I don't know. Oh, we should probably just start at the top here. Fed keeping their interest rates at zero. This isn't like kind of story, non-story, because it was pretty expected. So the article reads, as expected, the Federal Reserve kept its key overnight interest rate at 0 to 0.25% in a unanimous decision. The Fed also pledged to continue buying bonds to keep the coronavirus-damaged economy afloat and promised to maintain the current pace of about $80 billion in Treasury bond purchases each month and $40 billion in mortgage bonds. Yeah, any surprises here?
No, not really at all. I mean, yeah, they just keep. I mean, obviously, the Fed is still on the train of trying to pump up the economy and the stock market in the process. And yeah, I mean, I just as someone who's sort of relatively new to the markets, I'm just curious to see if all of this new money being pushed into the market creates any kind of inflation where the Fed will then be forced to raise interest rates. I mean, that was kind of the expectation out of the 2008. The GFC, the global financial crisis, and it really didn't sort of materialize into anything. So that's kind of where I'm at. Obviously we don't really make any decisions based on this, but
it's just interesting to watch.
It is interesting to watch, and interest rates have been so low for such a long period of time now. It's just going to be interesting to see what happens over the next decade or so.
Yeah, no, for sure. So they forecast the interest rates would remain near zero through to 2022. That's quite a big prediction. That's quite a way away. The Fed also predicted gross domestic product could slump by 6.5% this year, with the unemployment rate at 9.3% by the end of 2020. That kind of seems like it's in line with what most people have been predicting, although some predictions have just been like ridiculous. But I think generally, I mean, people have been predicting that it's kind of going to drop in that 6 to 8% range. I mean, unemployment's in America has gone from, 14.7 down to 13.3. So if it keeps kind of trending down slower and slower, then I guess hitting 9.3, there's not many situations where hitting 9.3% unemployment by the end of the year is a good thing.
Yeah, it's real strange. It's Yeah, because so I mean, obviously during the height of the lockdown, there was a substantial amount of jobless claims in the US, and then I think was it the last report that there was an increase of maybe 3.5 million people or something. Relatively, it was an increase, but relatively small. So another thing I'll be watching is kind of how many of those people who were on the jobless claims, how many of those are just going to instantly come back because businesses are just rehiring them straight back, whereas how many of them will be staying unemployed for an extended period of time. And I mean, and having a 9% unemployment rate target by the end of 2020 is substantially higher than it was last year. So for sure. It's very, very interesting times.
It's a big question. We've talked about it a lot. This whole jobs recovery. I remember talking to Tom about it a couple of weeks ago. Because because I did a video on it recently, in fact, yesterday or the day before, and there are just so many opinions which go in each direction. Some saying, as soon as we're allowed to open up, everyone just goes back to work, everybody starts spending again, and the unemployment rate will just drop as fast as it spiked. And then you hear the complete flip side of the equation where some people are saying, are you kidding me? Like I saw an article, I think it was on Forbes or something, where someone was saying that 42% of the coronavirus jobs that have been lost, the jobs that have been lost due to coronavirus are not going to come back.
Wow.
So like imagine if, okay, sure, you went from a 3.5% unemployment rate up to like 14%, but then unemployment could only get back down to 7% after all this stuff is said and done. I mean, that's still quite bad. And I mean, if that situation happens, then like 7% or even 9%, whatever the Fed's saying here, it's a substantial percentage of the population that's unemployed. I mean, it should just trigger a big, unemployment triggers that big economic problem of, unemployment rises, reduced spending equals reduced company revenue. Then companies want to save, or they're cutting costs because of their reduced revenue. They cut workers, and then the unemployment rate goes up even more, and it just kind of triggers that cycle. So, yeah, I don't know. I feel like people aren't people are so focused on the markets going up and they've bounced back to where they were. Like we're all good. Everything's opening back up. And then on the other hand, you get people that, or even like what the Fed's saying is like, yeah, even by the end of the year, we're still going to be at a 9.3% unemployment rate in the US. Our gross domestic product is going to have been decimated. I don't know. It's just like I referenced you in my recent video because of what you said in the last podcast, which I think is great. It just seems like the market right now is just getting so detached from what's actually happening.
Yeah. I mean, the thing is that the market is often detached. And I think that an important thing to think about is the market's rallying now. And you could definitely, I think it's fairly consensus that it doesn't represent what is happening in the economy in the US, at least right now. But where the market's going to go from here, I think is just it's still so uncertain. I mean, the market could just go sideways for an extended period of time while the economy catches back up. Or maybe the stock market panics and it comes right back down and it actually goes below the level of the economy as it's improving. Like the market can always do whatever it wants based on what its current sort of expectations are.
And I find it's so bizarre that it's bounced straight back up. And it's sitting at a Shiller P, which is double what historical averages are. I mean, it's a very highly priced market for extremely uncertain times. It's like super expensive. I just wouldn't imagine it'd be so expensive with it being so uncertain. Anyway.
Yeah, I mean, certainly the market is expecting that there'll be a not so long recovery. That the recovery will be relatively quick. But it'll be. I mean, no one knows what's going to happen. How long will unemployment? How long will the economy take to recover? How long will unemployment take to get back to its sort of I guess, more stable levels where most people are employed, or, more than whatever it is at the moment, 91%, or that's what they're aiming for the end of 2020. But no one really knows. I mean, it
makes me nervous.
It's fun to talk about, and it's fun to think about the things that can happen. But if you're trading on this information, then just good luck to you, because I would not want to be making a bet on when the economy is going to recover. I know that 10, 20 years it's going to be bigger and better, and there'll be more people employed and maybe in different jobs because of innovation. But I know that the economy will be stronger in 10 or 20 years, and that's where my bet will be. What's going to happen in the next 12 months? I'll just sit back and I'll get the popcorn out and I'll just watch.
I'm only here for the comments.
Yeah, exactly right.
All right, we'll snowball this one into the next story as well, just because it's pretty relevant. So there's a new report out from the Organization for Economic Cooperation and Development. It's an interesting name, but sure. All right. So they say, what do they say? Australia's economy. So now we're talking hometown. Australia's economy could contract by 6.3% this year if there is a second wave of coronavirus infections, according to the OECD, the Organisation for Economic Cooperation and Development. So what do they say? Should widespread contagion resume, with the return of lockdowns, confidence would suffer and cash flow would be strained. In that double hit scenario, gross domestic product could fall by 6.3% in 2020. Even in the absence of a second outbreak, GDP could fall by 5% in 2020. So, it's pretty bleak, like going on from what's going on in the States. It's definitely happening here as well. The only thing that's different about Australia, like our economy is getting decimated and the GDP's going down, but at least our unemployment rate hasn't gone up by too much, thankfully. And it's basically to do with the JobKeeper plan.
Yeah, it seems to have been pretty effective at keeping allowing a lot of businesses to not let people go. Yeah. But still be able to reduce their costs so that they can survive through. It's I mean, it has worked. It's been relatively successful. I mean, obviously, I'm not an economist or someone who knows sort of what the government's doing closely, but just from an outside perspective and looking at the top level numbers, I guess things like unemployment, then it seems to have done a not bad job.
Hamish, we are the best damn economists the world has ever seen.
Yeah, what am I doing?
We are Australia's top 2 economists.
Yeah, don't give us enough
that?
credit. Yeah.
You
know the government's listening, so we're
I turned down a position for the Federal Reserve over in the States just because I said, look, I'm just too busy. I'm just too busy with my YouTube channel, you know?
Yeah, sometimes the finance minister just like gives me a quick call just to make sure. Yeah. JobKeeper, you on board? Yeah. Okay, good.
Yeah, look, Hamish, I really just wanted to get your insight here. Interest rates, what should we do with them?
I'm just live right now.
Yeah.
I'm about to announce it.
Yeah. Just wondering, should we keep them where they are? What do you think about negative interest rate policy?
Yeah. I didn't think so either. Yeah. Thanks.
Yeah. No. Okay. Yeah. Yeah. Oh, cheers, mate. Cheers. Yeah. Thanks for that. Oh dear. No, man. Gosh, if we were economists, man, I would fear for the world. Gosh.
That's not a job that I would want to do. There's
just too much pressure. I don't know enough.
Yeah, and I don't even know if there's obviously some things that you can sort of predict, but there's so much unpredictability in what drives an economy, and we've seen our fair share of it this year. That it would just be a nightmare of a job. I wouldn't want to do it.
I wouldn't want to be an economist right now. They're all given their predictions, and then 2 weeks later they're completely wrong.
Yeah, pretty much.
I'm trying to look at what else did this article say? Reduced consumer demand and uncertainty weighing on business investment. Could lengthen the time it takes to recover. Yep. A key risk to the outlook is that high household indebtedness results in debt servicing problems potentially amplified by a housing market downturn and derails the recovery. That's probably something that might play out. It said in the best case scenario, Australia unemployment rate would hit 7.4% this year and 7.6% next year. So yeah, that's what I was talking about before. 7.6% unemployment. That is substantially better than what's happening in the States right now, where 13.3% of the population is unemployed.
Right.
And even that, this is a best case scenario. Like even that's better than the 9 point whatever percent we were talking about before.
Yeah.
But again, these are all just guesses, aren't they?
Yeah.
All just guesses.
I would love to sort of go back and listen to some of our previous podcasts and just sort of remember some of the numbers because we've been listening to numbers from similar organizations that have sort of been making these predictions, and just go back and see what they were.
We need a compilation video.
Yeah, of just like
another one that I'd find funny is a compilation podcast of all of the stuff that we've said that's either turned out to be correct or incorrect. That'd be kind of interesting.
Yeah, someone put that together. I'll pay you for it. Put that together.
It would be interesting. I mean, there's no doubt there's going to be some stuff that we got correct and some stuff that we were horrifically wrong about. But I think that we generally caveat what we say by saying that, look, we don't actually, like, we're smart enough to recognize that we don't know what's going to happen. We tend to always say that, don't we?
Yeah. I mean, it should go without saying. I mean, especially if you've had your eyes open throughout this year, it's pretty obvious that anything can happen in the economy, in just in anything in general, in health or whatever it is, to the point where there's no way that anyone could reasonably anticipate how things like this are going to play out. But
yeah. Do you want to talk about Thor?
Yes. So Thor Industries is a company that's disclosure. It's in my portfolio. So obviously I think it's a good investment, but obviously if you're going to be sort of doing your own research, then make sure you actually do your own research and just don't copy us, I think.
What he's saying is this is the best damn company you've ever laid eyes on, and if you don't plonk your entire net worth into this stock, then you are a fool.
Yeah, I'm just giving a quick
Is that right?
Yeah, just a quick disclaimer before I get started. All right, guys, Thor Industries, best company. Put all your money.
You're giving a disclaimer. Exactly. Anyway, tell us about it.
Yeah, so they reported their third quarter earnings, and basically, I can give you some of the numbers. So revenue came in at $1.68 billion, which was down 33%. Earnings per share came in at 43 cents, which was down 27%. But really, the headline is that they were able to remain profitable through this quarter. So Thor Industries is one of those weird companies that decides that they want to put their quarters on sort of not the typical calendar quarters. So this quarter...
Q5 2037.
Yeah, exactly right. So what was that company we were talking... Zoom, wasn't it? That had the most awful... thing. It was like garbage. Q1 of 2021 just happened or something. It makes no sense.
It's garbage.
Anyway, so their third quarter is for the months of February, March, and April. So I actually kind of like that. I mean, this time around in particular, but I kind of like that it happened to be those months, because we've had a lot of companies that have only captured March, right, so far, whereas we haven't seen any official numbers out of April, which was, for most countries, I think the US and Australia, it was the worst one in terms of the lockdown. So it's kind of a positive that we get to see sort of March and April together. But basically, so they remained profitable, which was a huge surprise to analysts.
Jeez, that is.
And really, the reason sort of I was initially attracted to Thor is because they have this variable cost structure that allows them to remain profitable all the time. And that is very, very unusual, not only for RV companies, but for just capital intensive businesses in general. So
how does that happen?
Yeah. So, basically, in terms of, so you have obviously you have businesses with different profit margins. You have ones that don't sell physical products, and they have really high profit margins, which means that even if their their revenues drop substantially, it's very unlikely that they will lose money. Whereas you have companies like Thor Industries where their typical profit margins are like 4 to 6%, and that's pretty similar to cars in the auto industry, for example, or the airline industry. And you see these businesses, they're very, very cyclical. So whenever there's a recession, you might see a 40 or 50% drop in their sales. And as a result, they lose a ton of money. And Thor has this structure where they somehow not somehow, I'm going to explain it, but they have managed to always remain profitable in every single year since they were incepted in about 35 years ago. Right. And I mean, part of how they are able to do this is they're able to quickly shut down. They have really good systems, so they're able to shut down their manufacturing plants so that when they're not selling RVs or the demand for their RVs is low, they're not just running factories and not running at peak efficiency. Right. And the other thing that they do is they don't sort of sit on inventory for very long. So they only build RVs to order. And most of the time they're built within 60 days. So they get an order in, they fulfill it within 60 days. And as a result, they don't really lose much money on sitting inventory that kind of goes stale. And there's a number of other sort of factors that go into that. But ultimately, it has allowed them to have this unique business in an industry or in a group of sort of capital intensive businesses that typically struggle in times like this. So they were actually expected to lose about 50 cents in earnings this quarter, and they did 43 cents positive.
Jeez.
And I kind of laughed at this. I mean, it kind of makes me because I mean, I certainly wasn't expecting them to lose money just because of my understanding of the business, and they've had quarters in the past where they've lost money, but management has been giving updates every single month, telling us that basically they're doing really, really well and they're probably not going to lose money. So the fact that the analyst consensus was they were going to lose about 45 cents in earnings kind of made me laugh. It kind of just shows that
analysts don't know nothing.
Yeah, I mean, I'm sure that the analysts that are covering this are probably also covering 200 other businesses.
Yeah.
And they're not sitting around and sort of learning about the history of this business specifically. They probably just look and see, okay, RV business, highly capital intensive, they're expected to lose 30 or 40% in their revenues. Okay, they're going to lose money. And it's like, it just shows that you can't really listen to the analysts at all.
It's so true. It's like another example is like when I follow Tesla, one of the reasons among many that I follow Gally at Hyperchange is now he's much more accurate than the Tesla analysts, because the Tesla analysts are also looking at Ford and looking at everything else and they don't quite get it. But I'm also following him because he breaks news about Tesla before any of the news sites do, because he's got this community going where people just like send him stuff. For instance, he was the first one to break the news that the Hornsdale power plant's getting upgraded with the Tesla mega chargers or mega packs, because one of his subscribers sent him photos of a truck going towards South Australia with mega packs on the back of it. So,
yeah, it's kind of insane. Like that's just some deep level inside information.
Exactly right. But yeah, like to go back to the point you're saying, I totally agree. Like these analysts are covering so many stocks. I mean, you're going to do far better and get far more accurate estimates if you go deep into one company and understand it really well, as opposed to trying to just follow an analyst that's, maybe spends one afternoon per week looking at your company and then spends another afternoon looking at two other companies and whatever. But yeah.
Yeah. And I mean, obviously Thor's business is being hurt substantially by this, and that they've had a really tough, probably the better part of the last 18 months with a big acquisition that led to them taking on quite a lot of debt, and then the RV sort of business cycle ended, so there was a substantial drop off in demand even prior to this drop off in demand, and all of that's obviously impacting their business. But the reason why I care so much about the fact that they're a unique business that can remain profitable is because as an investor, then I don't need to worry about the short term. I don't need to worry about how much money they're burning and whether they can sort of pay their debts.
That's true.
And sort of, I guess that kind of leads me into the other sort of main thing that's been on people's minds in terms of Thor Industries is their debt. So they took on about $2 billion of debt. I think it might have been 18 months ago now or 2 years ago in order to make an acquisition. And that's kind of been a big concern for people. Can they pay down this debt? So during the period, they actually took on another $250 million in debt just to be safe. So they actually increased their debt. And then they made an announcement last week that in May, so that's actually the fourth quarter that they haven't reported yet, they paid it down completely because they realized they don't need it. And that was a big boost to the stock price when that happened, because it kind of just showed that they took on debt to sort of be careful, to be cautious just in case. But the fact that they paid it back instantly indicates that they're seeing a strong pickup in sales in the fourth quarter, which is certainly a positive sign for their ability to stay profitable and also manage the remaining debt that they have to pay down, which now is about $1.6 billion, I think they have left. So they've got quite a way to go, but the stock's been on a terrific run out of all of this news. It's up 217% since March. So
far out.
I'm obviously very happy about that. But insane. It is still down from its high that was set in 2018, I want to say, maybe 2017. So it's down 27% from its all-time high.
Yeah, you've had some killer stocks in the last little while.
Yeah.
Texas Roadhouse has gone bananas as well for you, hasn't it? I haven't looked at that one in a little while.
Yeah, it's been abnormally good just because I was
abnormally good. Give yourself more credit, man. Come on.
It's just been unbelievably good. I mean, I'm obviously better than Warren Buffett at this point, so he can sort of step aside. No, what I mean is that there was obviously a portion of luck involved. Is sort of what I was alluding to.
Because of the short-term nature of it.
Yeah, and I was in quite a lot of cash prior to the drop off, which was by design, but because the drop off was so sharp, it just provided a really sort of, I guess, partially lucky opportunity to invest in these companies. And I know that for most companies, I think, and you've probably had this experience, most companies during that 37% drop or whatever the market did in March, most didn't get cheap enough. And I didn't actually invest in any new, I invested in one new company during that period, but I was mostly just adding to the businesses that I'd held for the past few years, such as Thor Industries, which got even cheaper. And the only reason I think they were in the right sort of zone for me was because they were already struggling. Like Thor had already had a terrible year prior to that. So it's and I mean, certainly now the markets are sort of back up to their all-time highs. The NASDAQ is at least. And yeah, there's just not much opportunity. I haven't invested anything since March.
Yeah, it's been rough. This rebound has just made everything so expensive. I tell you one thing that's also gone up on an absolute tear.
Yeah.
Tesla. Did you see this chart that I put in?
No.
It's pretty amazing. Basically, the chart is listing the top 25 automakers by market cap, and Tesla overnight just slid into top spot.
Whoa.
How unreal is that? So their market cap is 184.85 billion.
It's pretty insane because what does Toyota make? 10 million cars a year? 20 million?
Millions and millions. And Tesla makes hundreds of thousands of cars, which is insane. I mean, this is just a big vote for the future. I mean, people are just thinking that, obviously thinking that Tesla is going to be the future of auto manufacturing. So the list, I'll give you the top 5. So number 1, Tesla, number 2, Toyota, number 3, Volkswagen, number 4, Honda, and number 5, Daimler. So it's pretty unreal. I mean, they were battling it out against Ford not too long ago to be the largest. Was it General Motors? Yeah, General Motors to be the largest US automaker.
Right.
And it really wasn't that long ago that they were battling General Motors for the largest US automaker. And General Motors has a market cap of 41 billion.
Wow.
Tesla has 184 billion now.
Wow. Is Musk? There must be another tranche for his compensation at $200 billion market
But remember
cap,
what we were talking about? He has to sustain it.
Yes.
So it can't just spike, hit it, and then fall back down.
Correct, yeah.
It has to sustain it on, I think, a 60-day moving average, which is quite a bit harder to do. You obviously have to keep it up there for more than 60 days. So. But yeah, you're right, because it's in $50 billion market cap increments.
Right, yeah.
So, yeah, I mean, wait, did he get – I think he got – the last one he got awarded was for the $100 billion.
Oh, right. Okay.
So maybe it's 150 and then 2. So maybe if he can – I'm not sure.
Yeah.
I'd have to go and check. But, yeah, their stock price went up last night by 6%, I think, and first time ever it's crossed $1,000.
Wow.
This is a stock that was in the, what was
180?
it? 180, yeah, not like a year ago. So, I mean, that is ridiculous. I mean, I'm certainly glad it's in my portfolio, but but to be honest, like, there's no way when I invested in this company, I was sitting there thinking, yeah, this is $1,000 stock in a year's time. No way.
Yeah.
And to be honest, it's probably not $1,000 stock. Let's be perfectly honest. But it's pretty amazing. The market's doing some crazy things at the moment.
Yeah. And I mean, certainly its price is reflecting what's to come, what investors expect in the future. I could certainly see that because of the nature of the cars that Tesla makes, that they could earn a higher multiple even if they made less cars than some of these other manufacturers, just because of, I mean, I think we were speaking about this last week about the fact that they could have a subscription model, or they will have a subscription model for their autonomous driving, and there could be all of these other things that they could have sort of people paying for through the console in the car, particularly if no one has to drive anymore, or they don't have to pay too much attention, which seems to be sort of coming in the next few years, hopefully. Then that really opens up sort of Pandora's box in terms of how much revenue they can generate per person who buys a car. It's not just the 50,000 in revenue they get when you buy a Model 3. It's all of the money that you're spending on an ongoing basis.
So many other avenues. You're exactly right. And the thing is, even if those other avenues didn't exist, they're still outperforming the rest of the auto industry on margin as well. They get like a 20-ish% margin. So that must be, I can't remember what margin that is though. I'd have to go and check.
Probably gross margin.
Gross,
I would guess.
It'd have to be gross margin. Yeah, it wouldn't be operating margin. No way. So I mean, even that is pretty remarkable. So their demand is so strong that people don't mind paying that premium for their vehicles, which helps them make more money per car. And that's what keeps their margins up higher. So there you go. But interesting one. We'll leave that there. This is another interesting story that I saw, is that the Virgin Australia administrators are basically crying out for help at the moment.
Oh, no.
So the article says Virgin's administrator Deloitte has written to the federal government requesting the airline get financial support, including an extension of JobKeeper. The sale process is at a stage where there are two strong bidders wanting to purchase the company, but the uncertainty surrounding air travel could threaten it. The letter comes as airport workers head to Canberra to urge the Senate to pass a motion reversing changes to JobKeeper that would deny them the $1,500 fortnightly wage subsidy. So the letter calls on the government to extend the JobKeeper program for the airline's 10,000 workers for at least another 6 months and guarantee Virgin tickets. So there you go. To be honest, I don't know. They just keep asking, but if the government isn't budging, I mean, I think if they were going to have given them financial assistance, they would have given it to them by now.
Right. Yeah. So I mean, they've got some people interested in buying a stake or buying the entire thing. I see, and
they had 4 interested, and now they've got 2 main ones that are bidding, and the 2 that are bidding are Bain Capital, which is based in Boston, and Cypress Capital Partners, which is based in New York. So either way, you remember how we were talking about Virgin Australia not even being an Australian company, really. It's just completely owned by international companies. Well, even if it survives this, that is not going to change.
Yeah, it's fascinating. So I mean, I guess it's crazy that they could still very well go into insolvency, go bankrupt after this if air travel doesn't open up fast enough, if the people who are interested in making an investment just feel as though they're going to be putting way too much money into this for an extended period of time just to get any kind of return on this investment. Then, to
be honest though, when I'm looking at this situation and I'm looking at Bain Capital and Cypress Capital Partners and how they're saying that, we might pull the plug if you can't secure this, if you can't secure the extension of the financial support from the government, I feel like this is just the 2 bidders just trying to get the best possible deal, because I think that the buyers are definitely in the box seat here. So I feel like they're, even if they're getting a great deal, they're probably trying to pull every trick in the book to try and get a better deal, because the letter said that the 2 bidders are considering pulling out their bids because there's uncertainty around the air travel industry. So I feel like they're kind of just being like, well, we need a better deal than this. And the administrators are like, crap, we've only got 2 bidders that are actually coming to the table. We better try and sweeten the deal as much to make sure we actually get a deal done. So I don't know.
Yeah, that seems so wrong. That there's a investment company from Boston who's trying to pressure an Australian company to pressure the government into giving them more, basically just to get a handout. It's the most backwards situation ever. It's like,
you're not wrong.
You tell Scott Morrison, if he doesn't give us another handout, we will not buy your company.
We're not going to buy it. That's right. Because I mean, this extension of the JobKeeper stuff that they're asking the government for, this is going to benefit the new owners of Virgin Australia, because the JobKeeper payment will continue for months and months and months and months. So it's really exactly right. It literally is like these companies just asking for a handout.
Oh dear. Yeah.
Anyway,
it's been a. Do
we have any other?
Yeah, go on.
I was just going to say, do we have any other news topics, or should we get into some Q&A?
Yeah, no, absolutely. I think that's all the news that we had to talk about. So
yeah, cool.
Let's get into some Q&A.
I can't remember. Did we answer this first one? Did we answer it last week? I don't think we did.
I don't think we did. It's a fairly quick one. So.
Okay, let's do it then. So the question is, with so many trading platforms now, CommSec Pocket, NabTrade, Stake, Raise, all those different ways of buying shares, how many should a person get involved in, and how many is too many? What's your perspective on this?
Yeah, I mean, there's no shortage of different trading platforms, and they all have different benefits and different costs associated. I just like to keep things simple. I like having everything in one account, and I just use CommSec. And I know that CommSec is, I mean, if you just stack it up against some of the other platforms, it's certainly on the expensive side in terms of brokerage and the exchange if you're buying US shares. But I just like to know that my money is safe in a bank that's been around for a very, very long time. And they also have physical branches. So if I have any problems, I know that I can speak to a real person, and I don't have to hope that there's someone on the other end of the phone that can help me. And that's ultimately more important to me. And the other thing to mention, I think, is that it depends on how much money you're investing. If you're investing in small amounts at a time, so like, I don't know, if you're investing in less than $1,000 at a time with each investment, then you may care, well, you would care more about whether brokerage is $20 or $5 compared to someone who, say, is investing $10,000 or $20,000 at a time into an investment.
Yeah.
Because at that point, the brokerage sort of remains around, 0.5% or less, and it doesn't have too much of an impact. But I like to keep it simple.
Yeah. Yeah, no, I'm the same. I just have two. I use CMC, stockbroking, for Australian shares. They have decently cheap brokerage. I think it's like $11. And then when it comes to US trading, I just use Stake, and I have done for ages, just because they got a good thing going. I mean, I know I'm sponsored by them and all that, but quite honestly, I mean, it's free brokerage for American stocks. The only cost that you run into really is the foreign exchange conversion, where they take a little sliver. But get this, if you use like CommSec International, you still have to pay that foreign exchange fee.
Yeah.
But then you also have to pay like $30 US brokerage on top of that.
Yeah, exactly. It's 20 US, so it is about
20.
That's about 30 Australian at this point.
Right.
If you're right. If you're investing anything less than like $3,000 Australian at a time, then you're starting to have 1 or 2 or 3% brokerage on your investment, which is something you definitely want to avoid.
Yeah. Not to sound like an ad, but that's literally why I do like Stake. And when I was talking to the founder, that's basically what he was saying. Like, he used to live in the States, then he came over to Australia, and he is Australian, but he was living in the States, then he came back over to Australia, and he just found that it was so flippin' expensive to buy US shares. So it's like, we got to do something about this, and that's why he made Stake. So, but anyway, let's leave that one there. Next question.
Yeah, I can ask one to you.
Sure.
So I'll ask you this one. What are your thoughts on FANG ETF, FAN? For someone who doesn't have the time to dive deep into individual stocks, it is a bit of an unusual ETF. It only holds 10 stocks, which allows a bit more potential for growth, but less safety buffer than a standard ETF, exchange traded fund. Would love to hear your thoughts.
Well, I mean, I had a look at this, and the top 10 holdings, as you can imagine, with a FANG ETF, are basically US and actually some Chinese kind of techie stocks. So the holdings are Twitter, Facebook, Tesla, Nvidia, Apple, Google, Baidu, Amazon, Alibaba, and Netflix. And, for me, I mean, you guys know how I treat ETFs. I mean, for me, ETFs are trying to diversify across the whole market, dollar cost average, hold for a very long period of time. But I'm not saying that everybody has to treat ETFs the same way that I do. So, for instance, if you are someone that wants exposure to these 10 techie kind of companies, then, I mean, this kind of thing would suit you. And there's an advantage there in the fact that you don't have to pay, if you wanted to invest in all 10, you don't have to pay brokerage for every single one. Obviously, it's an ETF, so you just pay the brokerage once. So it could be a low-cost way to get into something like an ETF like this. But, I mean, overall, there are some companies in there that I like. There are some that I'm a bit on the fence about. So I don't think that I would personally buy it. But again, that's not saying that, you shouldn't. Obviously, it comes down to your own strategy. But yeah, I mean, if that does suit your strategy, then it seems like an interesting kind of way to go. The thing I looked at the 10 holdings list. Why does everyone always exclude Microsoft?
Yeah,
Why does no one ever talk about Microsoft? Like they put the FANG stocks, FAANG, Facebook, Amazon, Apple, Netflix, Google. Why does Microsoft get excluded? It's the biggest company.
Yeah, why is Twitter in there?
Yeah, why is Twitter in there and not Microsoft?
Is Twitter even profitable yet?
Jeez, I don't know. But I don't think they've grown their active users in about 15 flipping years or something. They're stuck at about 330 million active users, I think.
Right. Yeah.
But yeah, Microsoft just always gets forgotten.
Yeah, it does. And I mean, this is probably, just my personal opinion. Obviously, this doesn't mean you should do the same thing, but this wouldn't be something I would go into just because, just looking at the list, I know that a lot of these businesses often trade at a really high multiple to their earnings.
Very true.
In other words, the expectations for the future of these businesses is really high. And to be fair, the growth for these businesses in the future will probably be pretty damn good. It'll definitely be higher than the market average, I would say.
I would agree.
The nature of some of these businesses is just something we've never seen before the last 20 years. Businesses that, like Facebook, where Facebook and Alphabet, both of those basically have a duopoly in the new way to advertise. It's so low cost, so businesses are constantly throwing more and more money at them, and they don't sell any physical products. So that kind of business model is just an insane business that I think it's very likely if you combined those two together, at least these are the ones I've looked at. So if you combine them together, they'll do very well in the future, but compared to their price is kind of the key here. It doesn't matter how well they perform in the future. If you pay too much for it, then you might not make the return that you're expecting. And I like a traditional ETF that tracks the whole market because we have 100 years of data for that. And I can look back and say that, okay, pretty clearly these ETFs that track the US market, for example, go up with the growth in the economy in the US. And that has always sort of trended upward, at least for the last 100 years. So as a result, that's where I like to stay when it comes to ETFs. And when it comes to individual businesses, I'll stick to picking out a few businesses that I know quite well and that I think I can get at a good price.
Just so we don't get any comments, we do know that Google does make physical products. What Hamish meant is that they don't make substantial revenues from physical products.
Thank you for that correction. Yeah, absolutely.
That's all right. But let's go. Okay, should we do one more?
Yeah, for sure.
All right, let's. I'm just trying to scroll through, find a good one. Let's do this one here. What are the key parts of an annual or quarterly report that I should read for value investing?
That's an interesting question. There's a couple of parts that I usually focus on. The first is, of course, the very start of an annual report is it's usually called business or business description, and it'll give you sort of an outline of how they generate revenue, what are their typical expenses, who their typical competition is, and all of that. What are the factors that drive the performance of this business or the industry, and that's super important for developing an understanding of the business and its industry. And you can look at that section for, or this is at least what I do, I look at that section for the business I'm analyzing, but also all of the other businesses in the industry to sort of see what different management teams say about the industry and what drives it forward. Risk factors section, super important, understanding all of the risks that are associated with that particular investment. Again, doing that across all the businesses that you can find, all the biggest ones in the industry. Of course, the financial statements, you want to be looking at those, but then connected to the financial statements is the management's analysis and discussion section. So that's a really good section, because if there's a particular year where a company doesn't grow when they were typically growing, or they lose money or something, you can read that section and understand why. Why did the business, why did their revenues go down this year? And then you can see, oh, okay, it's the end of the industry cycle. So now I know a little bit more. I know this business goes through quite deep cycles, and let's see when the last time that happened. Okay, it was 4 years ago. So every 4 or so years, they go through this cycle where demand drops off, and they have to, and their profits drop off, and they have to kind of reconsolidate themselves. So that's a good section where you can develop an understanding of the little things that move the business around, sort of make it a little bit more volatile. And there's probably a number of other sections that I'm forgetting.
I mean, when I look at this, I just think, well, what are annual reports or quarterly reports really good for? And to answer that, I say basically what you've said. They're really good at giving you a detailed report from the management team on what the company is, what they're up to, where they're headed. And that's kind of that first section that you were talking about, where they actually go and describe their business, describe the risk factors, describe what each business segment is doing, like in words, and they actually tell you about what they're doing. And then once you kind of read through that stuff, then the other reason the annual reports and quarterly reports are really good is they give you an updated set of financial data to show you exactly how that business is performing. So all of that data then gets used to calculate all of the numbers that we like to look at. It helps us check up on, growth of revenue, growth of free cash flow, capital expenditures, blah, 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 all these numbers, how much cash they got in the bank, what are their assets like and their liabilities and their debt, all of that stuff. So I think when you're looking at these reports, it's like a tale of two different things. You look at all of the descriptive kind of learning about the business, what they're doing, what the growth is like, what the management's up to at the moment. And then after you've read through that, then you're all about the numbers and you're trying to figure out, is it still growing well and blah, blah, blah. But yeah, even when you're looking at the numbers, like what you said, underneath all that, then there's the management's discussion of the financial results. And that's where they'll tell you, if things have changed, why they've changed, why they haven't changed. And so on. So
yeah. All right. Well, I think that's probably, should we wrap it up there? I think that's a good place to sort of end it for today. Thanks everyone for tuning in once again. And we still have a number of questions that we need to get to. But if you do have any questions, then of course, head over to the YouTube version of the podcast, which is now at youtube.com/Young Investors Podcast. And just one thing I want to jump in with is if we can make the questions more concise, that'd be really awesome. I love that we're getting heaps of questions, but when it's just like a wall of text and it's going to take me like 3 minutes to read it when we're in the podcast, I reckon we should try and maybe condense it down to a couple of sentences or something like that. That'd be awesome. Yeah, absolutely. Yeah. So, thanks everyone for asking questions and listening and tuning in. Thanks, Brandon, for joining us. And
that's all right. Thanks.
Yeah. You are.
Man, you are so trash at these outros.
No, you always like come in with something. Like you'll be like,
yeah, that's true. That's true. You always trip over your own feet when you're doing the outros.
Yeah, I do. I was in the middle of scrolling up because I wanted to say thanks to our sponsor, Sharesight.
Oh, right. Yeah. Well, thank you very much to Sharesight because Sharesight helps us keep doing what we do with the podcast. But that'll do us for today. And thanks very much for listening, guys. We'll see you all next week.
See you guys.